Okay, so let's start our presentation. We are groups 13. Our group have 5 members, Billy, Amanda, and Jason, and me, and Rachel. So our topic regarding the is related to replications of total trading rules. The background is during 1983, there's 2 traders. One is Richard Dennis. Dennis has a debate with his friend William Eckert about whether the trading skill could be taught. One believed that the trading could be taught as a set of rules. If they strictly follow the rules, they can become a good trader. And one argued that the successful traders were born with a special instinct. So they start an experiment with 14 tortoises, which is participants. It's what claimed that these 14 tortoises has accumulated a compound rate of 80% per year in the next 4.5 years. So, and however, due to the secret contract, they are prohibited to disclose the trading rules for the coming decades. So they do obey this kind of secret. So as a result, we are really skepticism about rule that whether the tradings can be taught by using some rules or some teaching. So the question is it still working now? So in our project, we have defined some principle of the total trading strategy. The first one is the trend follow strategy. The second one is the position sizing. The third one will be stop loss precisely during the position initiators. And the third one will be long-term strategy. The fifth one would be price refresh signal, not the news. So the advantage of this total trading strategy is to emphasize on risk management and a good reward to risk ratio and potential for high returns. The potential drawback will be some missing short-term opportunities and forced entry point driven by noise. So we will have further illustrations of what is of the advantage and potential drawback later on after the end of the presentation. Yeah. So we have 6 main items in this system. The first one is we have to decide what market we are going to trade. And second one, we have to decide what is the position of sizing of each trade. The third one will how we determine the entry times of the trade. The fourth one will be the stop loss signal, when we should have a stop loss. And when also we have to decide when we have to realize the gain, which is the exit signal, and the tactic, the strategy to trade as well. These are the 6 areas that we are going to design and then strictly follow with the trade strategy as well. Yeah. So during this experiment, we are choosing the daily price data from from the November of 2020 at the 19th day of 19 and November 2020 to 19th and November 2021, which is 1 year data. And also we also use the 5 minutes data for this for the 1st of October 2021 and the 19th of November 2021. And all data is taken from Thomson Reuters. So we are mainly trading of the following 5 categories. The first one would be the corns, which is from Chicago Board of Trade. The second would be the sugar, which is Intercontinental Exchange. And then S&P 500 stocks index, and the gold and the crude oil, which is a common. These are all of those common index or common commodities in this trading market as well. Yeah. So here is the website that we are going to download the data from the system, and which is mainly from the Thomson Reuters website. So we just demonstrate how we download the data here. So next, I will pass the times to Amanda to talk about the rest of the project. Yeah, thank you.
Okay, for now, this part we have to data fitting in the system. The example have to change into the CSV. Okay, here is show you the Excel into CSV. For paper page 9, the data fit into the system. First one, transfer the data data into the date times format, arrange the CSV in the color orders with the earlier dates positioned at the top. Also, we have to add in 5 minutes data. There are times intervals without trade due to the non-continuous nature of trade hours, which means 24 to 7. Assume that no trading activity took place, the closing price, opening price, and other value remains unchanged. And then we have to use the last recording close price to estimate and fill in the missing value during the gap. In page 10 is the position size. The position size is the current assets of future trading strategy. It involves calculating the true rate, which measures volatility, and we are using a 20 days range of the true rates to terminate the position units for each trade. These units are sized so that a 1N movement represents a 1% movement in the capital. Once the position size is determined, the system book for 20 days. Could you please move to 11? Sorry. Yeah. Once the position size is determined, the system looks for 20 days breakout to initiate trades. The stop loss level are set to N to limit the potential loss, and stop gains level are based on the 10-day breakout. The strategy allows for a maximum for 4 units per trade. And the chart, page 12. Yeah. The price chart is the trading detail general. So as I say, it's the measurement of the, as I mentioned before, it's the measurement of 4 units only in each market. To invest or a long or short position in the assets, we will enter the trades when the Hon price surprise the highest or lowest price of upshards over the percentage 20 days breakout. Also, we have the stop loss set when price move against our position by 2N. Also, we have set a stop gains level when the price movement against our position to reach a 10 days breakout when the Hon price surprise the highest or lowest price option over the percentage 10 days, depending on whether it is limit a long or short position in the asset. Okay, in charge the trade detail and deep dive, which means the same one. Okay, let's go to the 13. The price scopes on setting out breakout points. The Python coding was used to implement the system, maintain daily and hourly price data, and running a loop for the break testing. Yes, it's 50. For back testing, the results were analyzed and performance measures such as cumulative returns and Sharpe ratio were calculated. This is 50 displacement, the daily price data or price data, which means we will let me see. Oh yes, the performance measures such as calculate return Sharpe ratio were calculated. Yes, this is 50 state. Yes, the 16 for loop to run the back testing. Let me invite Rachel to present this part.
Okay. So for loop to run the back testing, we have said if we initiate the position on whether it's a long or a short position is taken. So you can see from the code, if then is position equal to 0, that means it's a long position. So in the first if statement is saying that if the previous close is larger than the 20-day high, then we will set it as true. That means for long position. And we also set the unit and the price and the time also. So and also set the stop loss formula here. And for a short position is in the LS formula. So it's LF, so that means is for the short position. And then we set the Boolean is false, that means it's a short position. And we also set the price and the unit, etc. So we can go to the next page. And then this is to determine whether we will continue to invest or to stop the gain loss. So yeah, in the first if loop is like if it is a long position, then we will continue to invest. That and we have set the formula here, and it will saying how continue to long position at how much and for how many units. And then L is the statement we can set the stop loss formula here. And the next page. So it is the previous page is for the long position, and this page is the same, but just for the short position. Yeah. And next we'll find the result and to send it to the CSV file, and also print it like the successful rate is how much, the calculate the trade number, and also the P&L here. And then we will, this is what we print out the outlook. So for example, for one trading strategy, is like continue the long position at 72.31 and to long 14 at with a stop loss as how much. So it will calculate the capital. Yeah, and so it lists out, keep track of when and how much that we close or to initiate or continue our position. And you can see that the best trade is which one. And then we will plot. Okay. And we will plot the cumulative return graph through this Python code. And also we will also obtain the Sharpe ratio. And we'll pin out the Sharpe ratio. And I would like Jason to talk about the result.
Sure, thanks, Rachel. So we will now talk about the results. So the first graph here shows when we are taking 1% of price risk. We can see on the orange line, which is the performance of the turtle trading strategy. We can see that it is flat over a long time. It means that the position is not, we did not enter in position in quite a long of days, which fits the purpose of turtle trading strategy, which is not to respond with too much of the noise and make a long-term strategy. And we can see even though the future and index go in a different directions during the backtesting period, we can see the turtle trading strategy perform a positive return. We can go to the next slide to see what will happen about taking more price risk. Under a larger price risk, turtle trading strategy can outperform either the index or future only positions even more, as we can see here. And we can see a even better return when we go to the next slide of the 5% price risk. You can see that the difference between the returns of the turtle trading strategy and the future and index only strategies is even larger. So if we go to the next slide for this result summary, we can see that for the orange line, which represents the index and future only portfolio, which is around 1.4 of the Sharpe ratio. But for the turtle trading strategy, it has a larger Sharpe ratio, which is around 2.5, if more than 2.3% of price risk is taken. It represents an advantage is that for different risk appetite of investors, they can also try on this trading strategy to win the money. So if we go to the next slide, we'll talk about the limitations and improvements. The first thing is what kind of difficulties will we face when we try to implement this trading strategy? The first thing is about the trading cost, because when you are trading in the market, you will face several issues. The first thing is that you will have the market impact if your trading size is too large, and you also need some time to generate a signal when the price changes, which is about the opportunity cost. The third thing is about the fees, which is when you make a trade on the exchange, you need to pay the fees, which is slightly cheap in US, and this will be a main problem if you go to some other exchange like Hong Kong. So you need to consider what is the difference between the paper return and the actual return you get from the backtesting. The second thing we would like to talk about is the potential improvements. In the code here, we try to download the Excel from Thomson Reuters and then try to generate signal over time. But in the real world, if you want to materialize this trading strategy, the best way to do it is to automate the data feed and use the Reuters API function to generate all the signals and make the trade automatically, so that it is a real-time trading. The only monitoring will be using our code to see how is the position goes and how is the sort box making. The second thing is about the class object to simplify the codes to make the codes running faster to respond to the market quickly. The third improvement is we can try for different combination of the asset class. Currently, we only tried 5 exchange in the US, but more combination can be tried so that to see which assets will generate the good performance and a good reward risk ratio. The fourth one is after making a good selection on the asset class and all the automation, it's also important to have the optimization on parameters. As Richard also emphasized that the trading strategy has a flexible input of the parameters. This is the end of our presentation. Thank you for listening.